Good evening, everyone. Welcome to the channel. Before I begin, here are my disclaimers. Today I am going to give you an update about MACY'S Inc. annual report. MACY'S Inc. offers a wide range of businesses and services through its various brands. The company operates physical stores across the United States, as well as e-commerce platforms through its websites and mobile applications. This omnichannel approach allows customers to shop seamlessly across different channels. Under the Macy's brand, the company sells apparel and accessories for men, women, and kids, including cosmetics and home furnishings. Additionally, Bloomingdale's offers high-end merchandise, while Bluemercury provides luxury beauty products. The company also operates in international markets through license agreements with partners in Dubai, the United Arab Emirates, and Al Zahra, Kuwait. Macy's Inc.'s diverse portfolio of businesses and services caters to a broad customer base, providing a one-stop shopping experience for various consumer needs. Macy's Inc. market capitalization of $5 billion is materially smaller than most of its industry peers of roughly $9 billion. Macy's Inc. trades at a lower price-to-earnings ratio of 8 times and a lower price-to-book ratio of 0.97 times relative within the industry. This suggests a potential market detachment, as Macy's Inc. trades at discounted levels, while the broader industry remains fairly valued, warranting deeper fundamental analysis. The leverage on the balance sheet appears elevated, with liabilities of 70% of total assets. This raises some concern, and we should examine the industry and nature of the business to determine whether they justify the elevated leverage. Average liabilities have declined over the past 5 years, indicating improving balance sheet discipline and reduced financial risk. Shareholder equity has grown consistently, but operating income growth is weak or inconsistent. Equity expansion may be driven by financing activities rather than core business profitability. The company has consistently reduced its share count, reflecting a shareholder-friendly approach to capital allocation. The company have a dividend yield of 4.3%. The income statement shows that the company revenue have been declining annually and operating income have not been increasing. This shows that the business is under pressure with rising cost and its management is unable to expand the business. The primary drivers of revenue growth for Macy's are multifaceted. One key factor is the company's efforts to reimagine its locations, with a focus on modernizing and simplifying operations. This includes reimagining 125 locations and accelerating luxury growth through new brand introductions at Bloomingdale's. Additionally, strong performance from Bloomingdale's and continued comparable sales growth at Bluemercury have contributed to revenue growth. The company has also seen significant increases in credit card revenues, with a 25% growth rate, as well as an increase in Macy's Media Network revenue driven by its Amazon ad partnership. Furthermore, the company has reported a 20.5% increase in other revenue growth for 2024. On the other hand, the primary drivers of revenue decline are more straightforward. The net sales decline due to store closures is a significant factor, accounting for $529 million, or 2.4% of revenue. Additionally, decreases in gross margin rate due to tariffs and tariff mitigation efforts have also contributed to revenue decline. It's worth noting that some pages mention multiple factors affecting revenue, but these are the primary drivers of growth or decline identified by the company. The net income of the company experienced fluctuations between 2022 and 2026. In 2022, it saw a 7% increase from the previous year, reaching $1.23 billion. However, in 2023, despite not being directly impacted by mentioned risks, it decreased to $913 million. The trend continued with a further decrease of $270 million in 2024 to $643 million. Although there was an increase of $60 million in 2025 to $642 million, the net income dropped again by $37 million in 2026 to $79 million. The profit margins also underwent changes during this period. The gross margin decreased from 38.4% to 38%, implying a negative impact on operating profit margins as well. EBITDA saw a decrease of $195 million in 2024, while adjusted EBITDA increased by $259 million. However, the exact profit margins for 2025 could not be calculated due to missing revenue data. The company's financial performance indicates a strong ability to generate cash from its core operations. According to the latest data, the company has achieved positive operating cash flow in both 2024 and 2025. In fact, the net cash provided by operating activities has increased from $1,278 million in 2024 to $1,430 million in 2025, demonstrating a significant improvement in the company's ability to generate cash from its core operations. This positive trend is a testament to the company's efficient management of its resources and its ability to maintain a healthy cash flow. The increase in operating cash flow suggests that the company is well-positioned to meet its financial obligations and invest in growth initiatives, further solidifying its position as a financially stable entity. The company's debt level and interest expenses have undergone significant changes over the past few years. Initially, the ABL credit facility was reduced from $3,000 million to $2,100 million in 2025, indicating a decrease in debt. However, subsequent reports show an increase in debt levels, with the fair value of debt increasing from $2,467 billion in February 2025 to $2,307 billion by January 31, 2026. Regarding interest expenses, there is conflicting information across different pages. Some reports indicate a decrease in net interest expense by $18 million, 16%, from 2024 to 2025. However, other reports show an increase in interest expense net from $115 million to $135 million. Additionally, the interest expense net has fluctuated between -$97 million in 2025 and -$135 million in 2023. These discrepancies suggest that the company's interest expenses have not remained stable over time. Management is outlining a multi-year strategy called Bold New Chapter to drive sustainable, profitable growth. The strategy has three key pillars: strengthening the Macy's brand, accelerating luxury growth through Bloomingdale's and Bluemercury, and simplifying operations to improve efficiency. The company is focused on improving the customer store experience and driving traffic through investments in new store formats and digital channels. Management is prioritizing improving the shopping environment, elevating the customer experience, and closing underproductive stores to focus resources. Management is also investing in initiatives that support the Bold New Chapter strategy, including digital and technology investments. The company will continue to invest in these areas, with capital expenditures expected to be approximately $800 million in 2026. In terms of risk management, the company employs a liability matching strategy and diversification to mitigate risks. Management is focused on maximizing long-term return for a prudent level of risk, with an investment strategy that includes long-term capital growth and income through equity securities, real estate investments, and private equity investments. The company has demonstrated its commitment to returning value to shareholders through various means. One of the key ways it has done this is by paying dividends, with payments totaling $197 million in 2025 and $192 million in 2024. This indicates a consistent effort to reward investors for their loyalty. In addition to dividend payments, the company has also engaged in share buybacks as another way to return value to shareholders. In 2025 alone, it repurchased 17.7 million shares under a $2 billion share repurchase program. This strategic move not only boosts shareholder equity, but also demonstrates confidence in the company's future prospects. Concerns about inventory buildup and supply chain disruptions are prevalent in the extracted summaries. On page 9, managing inventory levels and merchandise selection is a concern, indicating potential issues with stock management. The possibility of unforeseen disruptions in distribution and fulfillment centers on page 11 further exacerbates these concerns. Delays in merchandise inventory receipts and product delivery due to various factors pose a significant threat to business operations. Page 14. This could lead to material adverse impacts on future product availability, mix, and sales if delays escalate. The potential disruption caused by labor unrest or shortages at ports on the U.S. West Coast, page 15, adds another layer of uncertainty. Climate-related weather events can also cause inventory buildup due to supply chain disruptions, page 17. Furthermore, a critical audit matter has been identified regarding the sufficiency of audit evidence over merchandise inventories, page 42, highlighting concerns about inventory management. The repeated mentions of inventory buildup across different page numbers reinforce the significance of these issues. Overall, the extracted summary suggests that managing inventory levels and supply chain disruptions are pressing concerns for businesses. That concludes the financial summary for Macy's Inc. Feel free to comment below, and I will be happy to answer them when possible.